Even though SOFI has lost more than 60% of its stock value in these gloomy markets, it still continues to remain a major player in the fintech space. Let's explore in this video about what SOFI does, latest news about it, how recent student loan repayment moratorium by the government is affecting it, and at the end, my perspective if this is a good time to buy, sell, or wait. Hi, my name is Sunny, and I make content that affect a common man financially. So let's dive into today's topic: SOFI, buy or sell. If you're new to this channel, please subscribe to it alongside smashing that like button, as that will help me with the YouTube algorithm, which of course will be highly appreciated. SOFI Technologies is a fintech company that uses AI to help people with their personal finance, where the use of machine learning offers its customers a fulfilling experience by better understanding their financial needs, thus offering them services accordingly. It has been gaining popularity recently as more and more people are turning towards technology for personal assistance. The stock is down close to 60% year to date, reaching almost $6 a share, which is close to its 52-week low. Even if you look long term, the stock is down almost 40%, thus bringing market cap of this Nasdaq listed company to just $5 billion, whereas the short interest has gone up almost 20% in the stock, which means people are expecting it to go down even more. It came as a good news for student loan holders when President Biden extended moratorium repayment for these loans. But for SOFI, who offer student lending, the news was not that great. Thus, the stock tumbled 7% last week as a result. The government has been extending these loan repayments since the pandemic, but its effect on lenders like SOFI is clearly evident when they cut their 2022 guidance both for sales as well as earnings. Some experts are of the view that this is not for the last time such loan repayments are being extended, which might give a bearish outlook for this fintech company. It has been on downward trend for a while now, but in my limited wisdom, the last leg of sell-off in the stock looks like race to the bottom, where the short interest reached 20%, which is not helping nobody as everybody wants to be on the right side of the trade. It might be a good, innovative fintech company that uses AI, but at heart, they are in the business of lending. So when you see loan repayments being extended where the reason can be X, Y, or Z, it definitely affects the sentiments of investors in the stock. Like most technology companies, they are still not profitable yet, as they are more focused on growth and customer acquisition along with retaining managerial talent, for which the industry standard is stock based compensation. Now, existing stakeholders feel that they are being diluted continuously, as such compensation has increased by nearly twofold in 2 years to nearly $230 million in 2021. Understandably so, all this is not helping the stock as it is touching new lows with no end in sight. Stock investing involves human psychology alongside understanding the financial fundamentals behind the asset that you are trying to buy. It is always a good idea to take emotions out while making investment decisions so that you can focus on the fundamentals, and using tip ranks can be a valuable tool. Based on today's price of $6.24 on Nasdaq, they are projecting a 12-month price target between $10 to $22 with average of around $14.86, thus a potential upside of close to 139% with a moderate buy rating. It is trading these days close to its 52-week low, whereas during its good times was close to $25 a share. That proves a lot of shareholder wealth is destroyed in the last not too distant future. Even though retail investors still have a very positive outlook about the stock, but according to tip ranks, the hedge funds have decreased their holdings by more than 8 million shares in the last quarter alone. Although insiders have bought 1.8 million worth of stock in the last 3 months, but if you take a step back and look at the snapshot of trading, it is clearly evident the smart money is out while the retail investors are in. In my limited wisdom, hedge fund managers are professionals who manage money for a living, Therefore, it is but natural they are always on top of their game as compared to retail investors. Don't get me wrong, I'm not trying to glorify or put down any set of investors, but don't you think retail investors are left with this declining stock? Now, if Biden administration extends the loan repayment moratorium once more, the increasing interest rate environment, what do you think is the short-term future for such a growth company? It's a fact when interest rate goes up, it changes the valuations of growth companies even if they are good. But in this case, they are facing some headwinds like this stock, then investing in such stock is not that I would prefer. I hope it makes sense as I'm just a random guy on YouTube having an opinion and not even a financial advisor. Please consult one before investing. If you have found value in the content that I make, please help me and my channel by liking, sharing, and subscribing to it. Thanks for watching and see you in the next one.